Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. Overall, as we entered May, prices were heading lower, out of the calm of April. The market dropped down and out of the zone between what had been the very recent 50% Fibonacci line at 33,860 and also the very recent 61.8% Fibonacci line at 32,250 3 weeks ago. 3 weeks ago, prices challenged and broke down through the short/medium moving average, currently 31,660. 2 weeks ago, prices dropped again sharply down to and then through the April 2011 high at 27,955 and flirted with the 2011 high at 27,330 and significantly approached the slowly rising medium moving average, currently 27,435. Under this medium moving average is a fairly free zone that stretches down to the August 2011 high at 25,195. Last week, prices pushed below the medium moving average into this free zone, but suddenly jarred to a halt at the round number of 26,000. Indeed, last Thursday saw a marked resurgent higher, with a big key reversal that day. This move closed above the medium moving average as well as the April and May 2011 highs. However, prices did not manage to punch up and through the late March downtrend, currently at 28,015. This downtrend is significant, as it is showing the bearish angle of attack since when prices started to calm down. Indeed, all that last Thursday managed was the market to kiss the downtrend and then on Friday form an immediate countering bearish harami. Yesterday was interesting, as the range encompassed the sharply heading downtrend from above against a support in a 26,000 area. Now, having studied the recent actions, I have a theory about why the market halted in the 26,000 area. I laid out the basis of it last week. You see, the August 2011 high at 25,195 is an interesting level, other than just the fact that is a significant high in the past. It is also the approximate start level from where we had the original huge rally in March, and it's the subsequent ghost highs. Hence, we would be back to where the market was back in late February, and it is the approach of the market to these levels that has prompted a premeditated response at a higher level in anticipation of testing the 25,195 level. Now, there is a time element in all this as well. By the middle of next week, the falling downtrend will meet the 26,000 level. And by the middle of the following week, prices will meet the next 25,195 level. Hence, if prices are to break the downtrend, then sooner is better than later. And this also goes for the 26,000 and 25,195 levels. One final point I'd like to discuss. Should prices get down to the 25,195 level, then this would not only bring in the late February low at 23,855 into play, but also the long moving average, currently 23,450. It's an amazing situation given where we were back in early March. LME 3-month zinc. There is once again a lot of interesting things going on here right now. I'd previously spoken about how I had on occasion taken a step back and looked at the monthly charts to get a better picture. From these I noticed a significant pattern that was still in operation plus a second pattern that was forming. The principal pattern was the 2015-2020 bullish Andrews pitchfork. The most recent event involving this pitchfork had been the market 3 weeks ago moving down through the middle tine, currently 39.42. This is not such a major event as you would initially believe, given the scale and size of the pitchfork, but it is still noteworthy. The second pattern, the one that is still in formation and also in operation, but it will require you to ignore part of March's actions. It is the 2020 to date ascending expanding wedge pattern, currently 35.09 to 47.10. Now this is a very, very important pattern, as I will show you. Okay, so first off, I know I asked you to ignore the explosive spike part of last March's action, but to be fair, on a monthly basis, whilst the upside of the ascending expanding wedge pattern had been breached, the market still hasn't seen a close outside of it. Not as yet. Hence this pattern is still valid, though interestingly during May we have seen it undergoing some severe bearish pressure, enough that 2 Fridays ago prices not only spiked down through the long moving average, currently 35.22, but also pushed down to kiss the lower trend line, currently 34.54, of the very same ascending expanding wedge pattern. This has proved to be an influential moment, as no sooner had prices dropped down and touched than we saw an immediate recovery back up in the market. Initially to the February 2018 high at 35.95, which coincides with the congestion seen back in January and February, and this week up to the August 2007 high at 37.80, and the May 2020 to date broken but optimized uptrend, currently at 37.62. More importantly, the move up this week challenged and broke the upper time, currently 35.09, of the, let's say, interesting early March to mid-April bearish Andrews pitchfork. This bearish Andrews pitchfork will be retired after this commentary, but before I do that, please note that this bearish pitchfork has been pretty good at showing the bearish angle of attack of this market since mid-April. However, this is now over, though I have taken the opportunity to draw a shallower bearish shift pitchfork for the same move. Right now the market has transited on the upside. Yesterday, the middle time for that, currently at 36.95. And has as yet never touched the lower or upper tines, so that's something to remember. Looking above, the next resistance is the slowly rising medium moving average, currently 38.34. Back in December, this had been a key support for the market, but 2 weeks ago, well, not so much, I'm afraid. Beyond that is the longer-term middle time of the 2015 to 2020 bullish Andrews pitchfork, currently at 39.42. And that, may I add, may be a more serious piece of kit as resistance. Overall, this market seems for the moment to favour the 2020 to date ascending, expanding wedge pattern as its main driver. For now, which is a very wide range within which a lot of things can happen. Anyway, finally, let's look at the ascending, expanding wedge patterns on their own. Well, for starters, they are usually not bullish. However, if the price breaks upwards, the quality of the move higher is usually seen as better than any break lower. We are far away from testing the two trend lines on this pattern, and way too early to start talking about any targets. However, as we seem to be well within this large pattern, I thought you ought to know these things ahead of time, just in case. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZE Tofpik and ADM Investor Services International Limited. And here comes the final bit.